Hi, I'm Tina Bishop. I'm a private client tax director at Azets, and this is my colleague Graeme Dreghorn, who is a financial planning director at our sister firm, Azets Wealth Management. Today we're going to be discussing the legislative background to personal tax, potential reliefs that are available, and some tips.
Tina, would you say that reviewing your tax position is worthwhile?
Most definitely. It's always worthwhile reviewing your tax position. You know, the allowances that are available to you are constantly being tweaked, and there's wholesale changes, and there's small tweaks on a fairly regular basis. So you want to make sure that you are aware of the reliefs available to you and reviewing if you can maximise those reliefs.
And what's the most common trends that you're finding at the moment?
I think on an annual basis, just trying to maximise the reliefs that are available, your allowances that are available, making sure if there's a higher earning spouse in the household that you're working towards using allowances in the most beneficial manner.
Mm-hmm. And what would you say the most common thing clients are asking you day to day when you're doing your work?
How to reduce their tax bill. Is there anything that can be done? Can we pass, a common one is to pass savings into the lower earning spouse's name so they can use allowances. There's allowances available for basic rate taxpayers that are higher than for higher rate individuals. So just planning surrounding that, really.
That's good, because there's a lot more people seem to be feeling the pinch with changes in tax at the moment, particularly from my side around savings and more interest that's been paid. So you probably see quite a lot more of that in tax returns as well.
Yeah, we've had a number of historical years when there's been lesser interest rates, and that income has been quite low, but we're now in higher interest rates, higher earning accounts, and it is beneficial to look at that position and see what we can do. So Graeme, has there been any changes to the pension legislation recently?
There's been quite a few changes. The one that maybe a lot of people haven't picked up on is the change in the annual allowance. Traditionally it was £40,000 a year at the upper limit you could go into a pension. That contribution limit's now increased to £60,000, so it changed last year. And this year it's also impacting. So there's a lot more money that people can save into pensions, which has been very beneficial.
And have you had a lot of queries on the lifetime allowance and the changes surrounding that?
Yes, I think that's been a really interesting area. It's very pertinent with the budget coming up as well, because we're in a situation where now there's no upper limit on how much somebody can contribute to pensions. What we've seen a lot of historically is clients who maybe have stopped paying into a pension because they felt they were close to the limit. As the world is today, we're looking at this thinking that we've now got a window to start saving into pensions a lot more, and it's a very important part of any financial plan to make sure that people have got enough money saved up for retirement, and having access to an account where you can get some tax relief in the contributions either personally or through your company not only helps with the tax now, but it also helps you pay for your retirement whenever you stop to work. Tina, are there any allowances that can minimise the amount of tax that you pay?
There are a fair few. Firstly, you've got your personal allowance available to everybody. First £12,570 of income is taxed at 0%. Unfortunately, not for higher rate earners. Those earning over £100,000 see their personal allowance starting to be tapered. So I think planning around that is pension planning, where we can put some more money into the pension to bring their income below that £100,000 threshold. That is minimising the effect of that. So individuals that are earning between 100,000 and the just over 125,000 threshold, it's really worth considering making that additional pension contribution to try and take the heartache out of that reduced personal allowance.
Yeah.
We've also got the savings allowances available. So for basic rate taxpayers, that's £1,000 of 0% tax charges on savings income. For higher rate individuals, that goes down to £500, and for additional rate individuals, that is zero. So we do look at, as I said before, putting the savings income into the lower earning spouse's name to benefit from those allowances. We've also got the marriage allowance, so where one member of the marriage or civil partnership is a basic rate taxpayer, but perhaps the other spouse has very low income below the personal allowance. There's the availability to transfer 10% of your personal allowance to the higher income spouse, and they benefit from 10% of a personal allowance, but only available for basic rate or, in Scotland, immediate rate taxpayers.
And is that something you find you do quite a lot with married couples?
Yes, it's quite common. Doesn't tend to be for working age couples, but we do see it being more relevant for kind of retired couples where one spouse has the lower amount of kind of pension income.
Mm-hmm. Is there anything that you would recommend to anybody watching this that would be useful to think about around their tax allowances?
I think just considering also other reliefs available to them, like pension contributions, and if they have other investments, rental properties, there is potential to split that rental income differently, so income is passed to the lower earning spouse. Mm-hmm. And what do you think, Graham?
I think right now there's another area that is important to think about, which is anybody earning between £50,000 and £60,000 a year, because that's where, if you have a family and you're earning child tax credits, where you can lose some of that allowance and get an extra tax bill. A lot of the time we talk about pension contributions for higher earners when you're in that income band over £100,000 because of that 60% tax trap. You can find yourself in the same position. So sometimes even relatively small pension contributions of £1,000 or £2,000, if it just keeps you under that threshold, you can find that actually your net pay difference is quite small, but actually you get more money paid into your pension and a lower tax bill, which is a good place to be.
Graham, what do you think individuals should consider when passing income on to loved ones?
I think from my side of it, from the financial planning side, a lot of it is, it's not just driven by the tax, actually, it's driven by the individual and the feeling that they have, because there's two aspects to gifting. There's what you want to see people enjoying now, and then there's also what you want to see people enjoying later in life. And the two things are not mutually exclusive. What you might want to do is enjoy giving some small gifts now, whether it's just cash gifts to family or whether it's doing simple things like just funding grandchildren's pensions or junior ISAs, because that's a nice thing to see today. But then the other side of it you need to think about is the legacy, and both are quite impactful on day-to-day finances. A really common allowance that we use is gifts out of regular income, which you know from the personal tax return is a really important area to make the most out of, because it's a way of passing wealth without any issues on inheritance tax. But we've got to make sure that we can do that in a way that doesn't affect your living standards, because if it's affecting your living standards, first of all, it isn't excess income. But also you want to make sure if you're giving things away that it's comfortable and you're not having to make any changes. So having a detailed budget plan, understanding what constitutes your household expenditure so that you can be very comfortable what's surplus, really helps you give that money away. And also, because we'll understand that, we can start to form a picture for clients of how much money they've got. Therefore, we can start to forecast how much money they're likely to need, and that gives us a reasonable idea of if they've got enough or if they've got too much. And it's a bit like Goldilocks in the three bowls of porridge. You know, most people will be just right, but some people can have too much. And if they do have too much, it's a really good time to introduce that discussion on how we give the money away. And then typically that's where, you know, we would work with, you know, the guys in you and your team to say, well, what's the most tax efficient way and what tax consequences do we have to think about that? So, I mean, from your side, when we're looking at gifting, what are you thinking about with your accountancy head on?
I think the first thing to think about is, you know, what is the inheritance tax position? Is, you know, that's probably clients' main concern is their liability to inheritance tax, and so establishing what level that is at is always a good start for a discussion. And then seeing what we can do. Is there an issue, and what should we do? And likewise, it's, you know, making sure we're planning for the future and they're not giving away too much. And within that, also considering other tax charges that may arise by gifting. You know, gifting of assets can trigger capital gains tax liabilities. We need the funds to pay that tax charge. Are there any reliefs that we can use that would mitigate that. And yeah, thinking also about deprivation of assets and the rules surrounding that. I think one of the most important things to remember is if we are gifting assets from inheritance tax purpose, we need to remember that we cannot benefit from that gift. If there is a benefit from that gift, then we're still caught within that kind of IHT regime, and the planning doesn't work.
It's very interesting because a lot of the clients we speak to, the first thing they think about is care homes, and if I just give away my house to somebody, then if I give it to the kids, then that'll be fine because I can stay in the house, but then it'll belong to them and there's not an IHT bill, and that's going to cause all sorts of problems, isn't it?
It does indeed. That asset remaining for their use just means that it is still caught within that IHT regime. It's still in their estate, and if they've gifted the asset, whilst if it can be seen that it was for the purpose of avoiding care home fees, then that can be attacked, and it can just be brought back into their assets for the purpose of covering their care home fees.
Because it is a very unique position, isn't it, in some ways, that with care planning, you're very much guilty until you prove yourself innocent because of this idea of gifts with reservation of benefit. And a lot of the times, certainly I find with clients, it is that case that they think I'm doing things in the right and I'll get checked out, but the mindset very much has to be the opposite, which is you've got to be absolutely sure you know what you're doing before you make any decisions, because you could be causing all manner of problems for yourself down the line.
Indeed.
Which will be wonderful for us because it will create lots of work, but probably for most clients, probably a situation they don't want to find themselves in.
Yeah, I think as with all tax planning, we need to be forward thinking. We need to be putting the plans in place rather than the transaction happening and then looking at what the tax effect is. It's very difficult to rewind, but it's much easier to plan for the future and implement the correct structure and transaction.
Yeah, and stressful, and what is a very difficult and emotional time for people as well. Definitely a stress you don't want to be adding to things.
What kind of planning now would you suggest to help with the future situation for your children?
That's a really interesting question, because there's a lot of pressing demands that you have to think about when you're thinking about planning for the future with your kids. It's expensive having children. I know this firsthand. There's so much money goes out for looking after them day to day, and that impacts on your budget. And again, going back to some of the basics of financial planning, just understanding what money's coming in and going out. It sounds like a really simple, straightforward thing, but it's amazing how many people don't actually look at how much money you have to spend. Having just dropped a couple of £100 on my own son's birthday party over the weekend, that, thankfully being a very boring financial planner, I had this all set out in a spreadsheet beforehand. But it can be something that can be unexpected for people, and at the first level, that's one of the first things to consider is actually, can you afford all the expenses that are coming up? And a lot of the time, that's being honest when you look at your budget planner about, have the kids got school trips coming up? Are they going away? Uniforms? And then if we look at, for example, like private schooling at the moment, we've just found a situation where there's going to be an extra 20% VAT on costs. So we've now got an extra cost that comes out every year. What we try to do is make sure that if we're structuring any type of financial planning investment strategy, if we're drawing down assets, what I try to do is make sure that the assets are in the right home, so that if we are taking money out for somebody, there's not an undue tax burden and that we have a runoff for it. What you don't want to do is be overly filling one particular bucket of assets that's going to pay a massive amount of tax. So if you look at assets that are liable to capital gains tax, that's a rate that's likely to change right now. A lot of what we're doing is trying to move people away from a capital gains tax environment to somewhere where they might be paying tax against income tax, using stocks and shares ISAs because there's no liability on that, and trying to create a plan where when you're taking money from retirement, as a client, to some extent, you don't really care about the tax that's there, because all you want is the money in the bank at the end of the day. But our job is to make sure that there's enough money there and that the plan behind it is robust enough so that if we do get shocks like this, that there's unexpected expenditure or the cost of things go up, we've got a means of paying for it.
Yeah, I think ISAs are a really beneficial wrapper to remember for income tax purposes. We're putting money into a tax-free wrapper, and we're keeping it out of that self-assessment tax, and they're very high rates of allowances that currently that we can put in.
Yeah, and I think the flexibility of ISAs is so useful right now as well, because as a couple, not only have you got £20,000 each, but you have to remember when you get to the end of life as well, now the ISA allowance gets absorbed into the partner, so you can effectively treat that pot as a large tax-free pot for the rest of the life of the couple as you have it. And where that can be good from a planning perspective is if we go to like a retirement scenario. If you are earning money from a pension, you're paying income tax on that, and that's fine for your day-to-day expenditure. But if you have, planning for like a child's wedding and you've got to find 10, 15, 20,000 pounds, you don't want to take an extra 20,000 pounds out of your pension because you're going to pay an awful lot of tax on that. The advantage of the ISA is that that money just comes out free of tax, so you end up with exactly the same outcome, which is £20,000 in your bank to pay for that wedding in that scenario. But the difference is if we do it from an ISA, there's no tax to pay. If you're doing that as a higher rate taxpayer, you could be talking another £4,000 or £5,000 on top of it that we've got to fund from that pension. So the trick to really good planning is to think about these things when we're constructing this 5, 10, 15 years before, so that we've got that flexibility to make sure that everyone's in the right position.
And do you see many clients taking advantage of the ISAs for children?
Not as many, in all honesty, as we would probably like. It's something that it's a very interesting conversation with junior ISAs though, because the one challenge with a junior ISA that you've got compared to some other things is that when the child turns 18, it's their money. And I had a conversation recently with somebody where they've just had a newborn baby and they were saying they wanted to fund the ISA for them. And that's a fantastic thing to do. But one of the other interesting conundrums you have is that do you want to be giving an 18-year-old £250,000 that you've got no control over? It's very hard when you've got a 6-month-old baby to know whether they should or shouldn't do that. So it's definitely something to use and think about, but you've got to think about it in the context of all the other things that you're doing. I think that's the thing I find with financial planning. It's one of the most enjoyable parts of the job is that it's never one size fits all. It's always very bespoke to the individual. You could have a family, you could have 2 children that would be entirely different. One of them, would be very sensible and you'd be really happy for them to have £250,000. One of them, you'd think, well, I maybe want to make sure that they don't get that until they're maybe 25, so we might use a trust, and the tax structure maybe isn't as attractive, but they're also maybe less likely to go away on a holiday and go absolutely crazy at 18 years old with £250,000.
Do you see many clients contributing into pensions for their children?
Not as many, again, as we would like to see, and I think that's a really interesting part of when we talk about intergenerational wealth planning. It's a really nice, easy way of compounding a really nice pot for somebody that does have an element of control to when they access it. You're looking at somebody not being able to access a pension until probably 60 now if we're funding for children, if the pension age is now 57. And it's not a significant amount of money. You're only talking about £2,880 that goes into a pension. But if you do that consistently over 5, 10, 15, 20 years, and you compound that, that's a really significant amount of money. It's a great legacy to leave, because if you don't have good pension provision, you have to pay an awful lot of your salary to make up that difference. If you are leaving what on the face of it can appear like quite a small legacy, but you compound that over time, you could be adding an extra £150,000 to your children or your grandchildren, just from what could seem like a small throwaway cheque. So it's something that we do try and do a lot more of, but it's not the first port of call that most people go to. What
is the first port of call?
Oh, it's definitely ISAs. I think that's the easy one. I think stocks and shares ISAs are the first place where it's the first allowance everybody uses, which is fantastic because if it's £20,000 up to a year of completely tax-free assets, that should be the first place that you do. It's a great place to find yourself in. The only issue that you can sometimes have is that people can get too much in ISAs sometimes. We talk about, when we think about estate planning, about should people have, the right amount or too much. If you're funding ISAs consistently every year for 10, 15 years, as a couple you could £500,000 sitting in tax-free accounts, which is wonderful if you're going to spend it. But if you're not going to spend it, it becomes liable for inheritance tax because it's part of your estate. And then either on our side we've got to think about structuring that differently, which brings more risk onto the equation, or you've got to think about giving it away, in which case for you guys you're then thinking about having to deal with the timing of a gift, because if we were to give away funds, you're then going to have to figure out for the liability for the next 7 years. So, what reliefs are available for self-employed or business owners that we need to be thinking of?
I think some of the main reliefs that I think about when I'm thinking about businesses is for succession planning and capital gains tax relief surrounding that. So on the sale of your business, it's business asset disposal relief. Look to make sure you qualify for that. You've got the correct holding period and the correct structure. So individuals would have a lifetime limit of £1 million currently, and that gain would be chargeable at 10%, whereas otherwise we're looking at 20% rates for higher rate taxpayers. So that can be very beneficial. So that's one good relief. And then just if they're passing on assets, the partners are passing on to a younger generation, then gift relief, rolling over that relief, that cost to the new individual, rather than triggering a gain on the disposal or the gift to that individual, is a big relief, and stops this kind of dry tax charge when people are trying to pass on their business assets. And reinvestments, sale of a business asset and purchasing a new business asset, the availability of rollover relief as well stops those kind of dry tax charges when you're wanting to reinvest in your business. So they're all good reliefs to be considering.
Yeah. And people must love you if you're able to cut a tax bill in half from 20% to 10%. That must be a great outcome for somebody if they're selling a business.
Yes, indeed. It's very nice relief to have. It was a bigger relief. Has been brought back somewhat from the earlier days, but it's still a nice big chunky relief to get on the sale of your business. So we just need to be mindful and careful that we qualify for that relief on a disposal.
Yeah. And how do you go about ensuring that somebody's in the right position to benefit from that relief?
It's just a review of their business structure, making sure that their business qualifies in the first place, and whether we can implement anything for a future sale. For instance, bringing a spouse in to then have a share of that business, which further down the line, after a 2-year qualifying period, we could also, the other spouse could also benefit from that lifetime relief as well in a business sale. So it's just looking at forward planning and seeing if there's anything we can do for that.
One area of tax planning that could be quite interesting that we both do a little bit in is looking at like venture capital trusts and the release around VCTs. How do you find that practically? Where do you use that?
I think that's really a planning tool. Usually the clients will come to us and they'll have already invested in a VCT, and we are, claiming the reliefs that are due to them. So the income tax relief, which is 30% on the investment, and when dividends are paid out from that VCT scheme, they are not taxable in the hands of the individual. So it's a good additional relief to have. Mm-hmm. And yourself?
Yeah, I mean, it's a very interesting planning tool for us, because it can be quite good when we're forward looking if we understand somebody's marginal tax rate, because we can use that VCT investment. If somebody's got cash in the bank, that 30% relief can be really attractive because it can bring down the rate of tax that someone can pay. Also, when we get to the quite sophisticated end of planning, actually what we can do is we can ladder venture capital trusts as well, because they've got a 5-year holding period. If we can set up an investment of a VCT over 5 years, by the time you get into year 6, they are to an extent quite self-perpetuating, because you can use the initial capital plus the dividends to keep fueling that tax relief. So it's a very exciting level of planning. It's not for everybody, but it gives real opportunities to really bring down somebody's tax rates. And the underlying investments for them, they are risky. That has to be the nature of it to get the tax relief. And we're very careful about the criteria of investments that we put in front of clients, and make sure that clients that are going into it are in the correct position to use it, because it's not a tool that's for everybody, because the problem is with these high risk investments, they can go wrong very, very quickly. But if you do have somebody who's in the right space to use it, and what we use is we look at a phrase we use is what's called capacity for loss, which is understanding if something were to go wrong, how would it impact on your day-to-day lifestyle. If you're in a position where you can make an investment in a VCT where it's going to give you a tax benefit and not impact on your day-to-day lifestyle, then you get the advantage of potentially some very nice growth if there's a good investment, tax-free dividends, and as we said, something that can become self-sustaining over the time. So for the right people, it very much can be a very useful tool.
I think another common one we see quite often is enterprise investment schemes, especially when there's been a sale of a business and there is a big, portion of capital that could be perhaps used in the riskier side of the market, and claiming the deferral reliefs available and the income tax reliefs available. They seem to be nice popular.
And I think it's when we're dealing at these riskier products, I think that the nice thing is you're typically at a point where you're less worried about the day-to-day. If you look at the priority order that we would take of investments, if you start with stocks and shares, ISAs, and you move on to pensions, and then you look at more general investments, you've normally gone through quite a lot of things and you're in a fairly settled position. So when we start looking at reliefs on venture capital trusts and enterprise investment schemes, we're normally in quite a comfortable position financially that allows us to take a little bit more risk, and it's good for the economy. That's why these EIS schemes are there in place, because it encourages investment in small startup businesses. And the great thing from an investment perspective is if you get an EIS investment that goes well, it really goes very, very well for people. The trade-off, of course, for balance is when it goes badly, it can also go extremely badly as well, which is why we have to be careful about that type of vehicle. But it's like anything, it's about using the right tool in the right situation, and they can be very attractive in terms of the upside for it, as long as you go into it with your eyes open, I think, about what's there. I think you wouldn't want to go into it not understanding what you're investing into. But I think if you're getting good advice from good professionals and you understand the good and the bad, and you can make an informed decision, that can put you in a really good place. Thanks very much for that, Tina. That was a really useful discussion. Thanks for your time there.
Likewise.
So at Azets and Azets Wealth Management, we strongly believe that getting good professional advice and planning ahead of time is the most important thing that you can do. If you have any questions about anything that we discussed today, you can either contact myself, Graeme Dreghorn, or my colleague here, Tina Bishop, and we'd be delighted to help you with anything that might crop up.